how do you make money as an investor? The people who don't know think the way you do it is by buying good assets, a good building, stock in a good company, or something like that. That is not the secret for success. The secret for success in investing is buying things for less than they're worth. As you know, I wrote a book in 2011 called The Most Important Thing. And the reason it has that title is because I would find myself in my client's office and I would say, the most important thing in investing is controlling risk. And then 5 minutes later, I would say the most important thing is to buy at a low price. And 5 minutes later, I would say the most important thing is to act as a contrarian. And so back in 2003, I believe, I wrote a memo called The Most Important Thing. I listed 19 things, each of which was the most important thing. And then I used that. I couldn't think of a better format for my book, so I used the same format in 2011. Interestingly, some of the things are different. And that's just supposed to show you that one's thinking should still be alive and should still evolve. And I know that Sir Rob and some of the other fellows went to see Charlie Munger speak in Los Angeles this week at age 91. And I'm sure he's still evolving and getting younger. So I'm going to try to do the same. Now, I should tell you, and I don't know if you know this, but I write memos to the clients. And I'll refer to a lot of memos in this session probably. And they're all available on oaktreecapital.com website. And the price is right. They're all free. And so, I've been sending them out now 25 years. I started in 1990. And I got a letter from a guy named Warren Buffett in 2009 or 10. And he said, if you'll write a book, I'll give you a quote for the jacket. And so I had been planning on writing a book when I retired from work, but Buffett's promise caused me to accelerate my time frame. And what the book is who here has read it? Okay, about half. So what the book is, it's a recitation of my investment philosophy. And as it says in the foreword to the philosophy, which I took the foreword, I don't know about you, I never read the forewords of books, but I took the foreword to mine very seriously. And what it says in there, it's not designed to tell you how to make money. And it's not designed to tell you how easy investment is or to try to make it easy. And in fact, my highest goal is probably to make it clear how hard it is. Investing is very difficult because it's kind of counterintuitive and it kind of turns back on itself all the time. And there are no formulas that work. So what I tried to do in the book is teach people how to think. And now the thoughts they should hold change from time to time. But how to think, I think, is valid in the long term. So it's my investment philosophy. And I wasn't born with an investment philosophy. You'll hear from a lot of people, if you're interested in investing, who'll say, well, I started reading prospectuses at age 8. And I didn't. At 13, I invested my bar mitzvah money, which I didn't do. But, and in fact, when I was getting out of graduate school, age 23 in 1969, so I know you can all do the math, I didn't know what I wanted to do. I had studied finance at Wharton and accounting at Chicago, and I knew I wanted to do something in finance, but I wasn't very specific. So I interviewed in 5 or 6 different fields, large consulting firm, small consulting firm, accounting firm, corporate treasury, investment management, investment banking, 6. So, I ended up in the investment business. Why? Because I had a summer job in 68 at Citi in the investment research department. I liked it. Had fun, right? That's a good reason. So I went there. And by the way, interestingly, there was nothing magical about working in the investment business at that time. It paid the same as all the rest. All 6 jobs that I was offered had the same pay, between $12,500 and $14,000 a year, not a month. And there were no famous investors at the time. Investing was not a household word. There were no investment TV shows. So I just did it because I liked it. I liked the people, and I thought that the investing was intellectually interesting. So I didn't have a philosophy then when I started. And I had some things I had learned in school, but I think that your philosophy, as opposed to somebody else, if you studied Descartes or Locke or somebody like that, you learn his philosophy. If you might learn a philosophy by studying a religion, but that's not your philosophy. Your philosophy will come from the combination of what you have been taught by your teachers and parents and your experiences. and what your experiences tell you about the things you were taught and how they have to be modified. So I developed my philosophy over, it might seem like I started writing the memos a long time ago, 25 years, but I had been working already over 2 decades at that time. So I think that the integration of real life into philosophy is essential. Now, I prepared a few slides for today, and basically the slides are here to illustrate where the philosophy came from. Talk to you about some of the foundations and roots. So I call it Origins and Inspirations, and I hope you'll find it interesting. So first of all, not in order chronologically, but hopefully in order to try to make something intelligible. Fooled by Randomness by Nassim Nicholas Taleb. Now, who here has read that? All right, more people than have read my book. And I think it's very important. I think it's an excellent book with very, very important ideas. Now, don't tell Nassim I said this, but I tell all the people I speak to that it is either the most important badly written book or the worst written, very important book that you'll ever read. I think it's not very clear, and I think it's well, maybe there's no attempt to make it clear. But I think a lot of the ideas are very important and even profound, in my opinion. So among other things, and the basic theme is that in investing, there's a lot of randomness. And if you look at investing as a field without randomness, where everything is determinative, you'll get confused because you will not draw the proper inferences from what you see. For example, just a brief example, you see somebody and they report a great return for the year. The scientist who thinks that the investment world runs like the world of physics might think, well, great return, that means the guy's a great investor. But in truth, it might be somebody who took a crazy shot and got lucky. Why? Because there's a lot of randomness in the world. When I went to Wharton, 1963, the first book I remember learning was called Decision Making Under Uncertainty by C. Jackson Grayson, who became, as I recall, America's first energy czar. And I learned a couple of important things from that book. Number one, that you can't tell from an outcome whether a decision was good or bad. It's very important. Most people don't understand this. Totally counterintuitive. But the truth is, in the real world where there's randomness at work, I mean, if you build a bridge and it falls down, then you must assume that the engineer made a mistake, that it was a bad decision to build the bridge that way. But in the real world of where there's randomness, good decisions fail to work all the time. Bad decisions work all the time. The investment business is full of people who are, quote, right for the wrong reason. Made a bad decision. It didn't work out the way they thought, but they got lucky and they were bailed out by events. So this is very important, and this is the basic theme of Fooled by Randomness, Taleb's first book. Since then, he has written the Black Swan, which became more famous, but I don't think is as good a book. And he's written a book called Antifragile, and that one didn't get famous. But I think that this book is something everybody should read it if you have an interest in numbers, investing, and how the world works. So it's, as I say, the book is all about the role played by luck. And basically, even if you know what's most likely, many other things can happen instead. This is very, very important. We talked earlier at lunch about what's the most important lesson you can draw. Well, of course, I'll never say most important to anything, but one very important lesson for you to learn is that you should not act as if the things that should happen are the things that will happen. Again, in the world of the physical sciences, you can probably bet that that's true. And the electrical engineer knows that if he turns on a light switch over here, the light will go on there every time because it's subject to physics, not in the world of investing. And so for every possible phenomenon, there is a range of things that can happen. There may be one where it's possible to discern which one is the most likely. And if we draw a probability distribution, that may be the highest point on the distribution, the most likely single outcome. But that doesn't mean it's going to happen. And the reason we don't have many probability distributions that look like this, but rather that look like this, is because a range of things can happen. And it's very, very important to notice that, number one, there are lots of things that can happen, so you have to allow for them. And number two, the thing that is most likely to happen is far from sure to happen. So that's very key. There's a professor at the London Business School who put it succinctly. He said, risk means more things can happen than will happen. And this is profound, in my opinion. In the economic world, people generally make their decisions based on something called expected value, which is to say that you multiply every possible outcome. First of all, of course, you don't think in terms of a single outcome. You think in terms of a range of outcomes. So you take if you could iterate over so many, you take every possible outcome, you multiply it by the likelihood that it will happen, you sum the results, and then you get something called the expected value from that course of action. And you choose your course of action based on the highest expected value. And that sounds like a totally rational thing. But what if the course of action that you're considering has some outcomes that you absolutely can't withstand? Then you may not do it. You may not do the highest expected value course of action because it has some you can't live with. Who here is willing to be the skydiver who was right 98% of the time, for example. So you may elect to do bike riding on the Google campus rather than skydiving, even though skydiving is more exhilarating 98% of the time. Anyway, so the point is, as I lived my life from learning about Dimson, learning about Taleb, learning from my own experience, I realized that should does not equal will. Lots of things that should happen fail to happen. And even if they don't fail to happen, they fail to happen on schedule. So the thing that the economist or the financier thinks should happen this year may happen in 3 years. You got to live 3 years to see it happen. One of my favorite sayings is, never forget the 6-foot-tall man who drowned crossing the stream that was 5 feet deep on average. We can't live by the averages. We can't say, well, I'm happy to survive on average. We got to survive on the bad days. You got to survive, and if you're a decision maker, you have to survive long enough for the correctness of your decision to become evidence. And you can't count on it happening right away. I always remind people, overpriced is not the same as going down tomorrow. And if you bear that simple truth in mind, I think it helps. So Taleb and the role of luck, very important.
And there you have it. This was just the first part of an exceptional lecture by Howard Marks, a true legend of investing, sharing decades of wisdom that few ever articulate so clearly. In a world obsessed with predictions, models, and shortcuts, Marks challenges us to think differently. Not about how to make money fast, but how to survive, endure, and thrive in the long run. He reminds us that investing is not a science of certainty. It's a practice of probabilities, of understanding that even the best decisions can fail and the worst ones can sometimes succeed, because randomness is always part of the game. What matters isn't being right all the time, it's being thoughtful, humble, and above all, prepared. He shows us that the most important skill in investing isn't forecasting the future, but managing your behavior when the future doesn't go as planned. If you're serious about mastering this craft, this talk is not just insightful, it's essential. And the best part? This is only the beginning. More is coming from this incredible session with Howard Marks, so stay tuned. Because the deeper we go, the clearer it becomes. Great investing isn't about knowing what will happen, it's about knowing how to think when it doesn't. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the Com Lucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.